On this episode of the Next Big Thing podcast, we welcome on venture capitalist Martin Tobias for the first episode of our investor series. With this series, we aim to extract the lessons, principles, and frameworks of the top venture capitalists to better help retail investors in their search for a great deal.
Come join us on our mission to discover the next equity crowdfunding startup that will change the world. Please like, comment, and subscribe to the channel down below. It would mean the world to us, and we really appreciate it. Enjoy the episode. You're not going to want to miss it.
What's going on, everybody, and welcome back to another episode of the Next Big Thing podcast, where we usually interview the founders and CEOs of crowdfunding startups. Today, however, we bring to you the first episode of our investor series, something me and Connor are super excited about, where we aim to extract the lessons, principles, and frameworks of the top venture capitalists to better help retail investors in their search for a great deal and entrepreneurs navigate the incredibly hard landscape of finding funding. Today, we welcome Martin Tobias, a serial entrepreneur and the current founder and general partner of Incisive Ventures. Martin started his career at Anderson Consulting, now Accenture, and Microsoft in the late 80s and early 90s. Before becoming the chairman, founder, and CEO of Loudeye Technologies, the last company to go public in the dot-com boom. He has also founded companies such as Cashless, Eliminate Angels, Retree, and has been the CEO of multiple others, including Imperium Renewables, Tipper, and Upgrade Labs. During this time, as a leader of many companies, he has raised over $500 million in venture funding and had 2 initial public offerings. His venture career started in the late 2000s when he became a venture partner at Ignition Partners, helping generate deal flow, working with entrepreneurs, making investments, and sitting on the board. Along with his venture investments as a partner at Ignition and the managing partner at Incisive, he has also made over 250 angel investments and is a limited partner in over a dozen VC funds. Some of his most notable investments include the early days of Google, DocuSign, OpenSea, and Jeeves. Martin is known for his 7 meta themes and screening process to identify outlier companies and founders. As I said earlier, he is currently the managing partner of Incisive Ventures, a pre-seed venture fund that invests up to $500,000 in entrepreneurs. Something that we're going to get into is the difference between pre-seed and maybe other parts of venture capital, something Martin talked about before we started recording, super interesting. He speaks his mind and shares his insights on Twitter, where you can find him at Martin G. Tobias. That's MartinGTobias. And he's also on LinkedIn. With that being said, thanks for taking the time to talk to us, Martin, and welcome on the Next Big Thing.
Oh, thanks, Brendan and Connor. Thanks for having me. And I didn't realize I did all that stuff till you just read it back to me. So yeah, it's been a long career, and I'm really excited at this phase in my career to work with young entrepreneurs and help fund the next generation of people disrupting things.
Now, Martin, let's jump into it. When you say pre-seed investor, what does that mean? What type of companies are you looking to invest in?
That's a good question. And I posted something on my blog on incisive.vc. It's called How I Define Stages. And, when Ignition wrote the Series A check of DocuSign, we gave them $4 million at a $7 million pre-valuation. And that was a Series A in 2003. Today, that would be what's called a pre-seed round. So in the last 20 years, the number of stages has expanded quite a bit, and the terms can get complicated. But the way I define it is basically if you have an idea for something, a piece of software, and this is all, I'm talking about B2B software companies. If you're talking about hardware or drug discovery companies, the stages might be slightly differently. But for B2B software companies, if you have an idea, but you haven't written an MVP yet, you have no code yet, I call that the angel round. You should get $400,000 or $500,000 from your friends, your parents, whoever you can to build the MVP. Once you have an MVP and you've been engaging with customers, even 2 or 3 customers, you have $4,000 or $5,000 a month of revenue. I call that pre-seed up until you've been generating about from basically $20,000-$30,000 a year of revenue up to $400,000 or $500,000 a year of annual recurring revenue. That's pre-seed. The seed round, and you're going to raise in the pre-seed between $500,000 and $1.5 million. The seed round is once you have $400,000 or $500,000 of revenue. The larger $100 million funds are going to get interested in writing you a $2 to $5 million seed check, but they're going to want to see $400,000 or $500,000 of revenue, and that's called the seed round. Series A companies are raising $10 to $15 million Series A's at $40 million valuations once you've crossed $2 million of annual recurring revenue. And those bars have gone up in the last year, probably about 100%. Seed used to be 250, now it's 500. Series A used to be 1 million, now it's 2 million. And what entrepreneurs need to understand is that the bars for each of these rounds is always changing. And it's important when you are going to talk to investors to make sure you're talking to investors that are looking for the right stage that you happen to be at. If you are at the ideation phase where you've just got the idea of building something, you've not built an MVP, you need to be talking to angels or individuals. Maybe there's a few potential pre-seed funds, but you're really too early for any fund that's over $50 million. Once you have an MVP, you can talk to the smaller funds, the $10, $20 million funds, maybe some bigger angels. But the $100 million funds, the funds you read about in TechCrunch, they are not going to be interested in you until you've got $400,000 or $500,000 of revenue, or if you're a third-time, founder who went to Harvard or Stanford.
So why do you want to be a pre-seed investor, or why are you a pre-seed investor? Why not, a seed investor or a Series A investor?
Well, there's a couple of reasons. First of all, I think you can make the biggest impact as an investor in the pre-seed. Because typically in pre-seed, you've got 2 or 3 people. You're still trying to figure out your product market fit. Introductions to the first 5 customers are super impactful at pre-seed. I can make those introductions. I think I can make a big impact at pre-seed. The other thing is that I have a $10 million fund and I write $250,000 to $500,000 checks. My fund is not large enough to write those $2 to $3 million checks in the seed or the Series A. And frankly, there's a lot less competition in the pre-seed. If you look historically at all the unicorns that have been created, basically 72% of the unicorns that have ever been created were funded in the Series A by a tier 1 firm that you've heard of. So Sequoia, Andreessen Horowitz, somebody like that. What that tells you is that at the Series A, it's actually really important to get one of the big billion-dollar funds to give you money because it's highly correlated to returns. Less than 5% of unicorns were funded in the pre-seed by a tier 1 firm. What that means is that there's a lot less competition at the pre-seed. There's a lot more people doing pre-seed, and those big firms look to firms like mine to find the companies that they want to write the Series A checks into. So in the pre-seed, if you're raising $500,000 to $1.5 million, you're typically getting 3 or 4 funds like me together that all do different things that all add value to the company. In a Series A, typically the sharp elbows come out and a VC fund wants to hog the deal and a company is stuck with one investor. Now, if it's the right investor, that could be great. But early, what you want is more people to help you introduce you to more of those first customers, hiring, and all of those things. Frankly, I think it's better to have a larger cap table early because it helps the entrepreneur. And I have found that pre-seed funds are very sharing and friendly and amicable versus the Series A funds where it gets very competitive. And by the way, you need a couple $100 million fund to compete for those things, and that's not what I want to do.
So now that we've kind of laid the groundwork of what pre-seed does, I want to get into your investor framework. You've had a very diverse career with a lot of different things going on professionally as a leader, as a venture capitalist. So can you maybe take us through your career and how your career impacted your investment thesis and your frameworks that you use today?
Well, on my blog, I did write that thing, the seven meta themes, and those seven meta themes sort of came out of the pandemic. Because basically, when I was at Microsoft, I left. I started a company called Loud Eye Technologies, took that public in March of 2000, the absolute last company to go public in the dot-com boom. Then I was a VC for a while. Then I started another company and took that one public in renewable energy. So I've gone back and forth between investor and CEO a whole bunch of times. And basically, at the beginning of the pandemic, I was running a company for a friend in LA. It got shut down by the pandemic because it was a physical retail medical clinic company. And so I had some time on my hands, and I said to myself, why don't I look at all the investments I've ever done and try to figure out where I was any good and where I got lucky. And those seven themes came out of analysis of, at the time, about 200 investments. And those themes came out of my looking at those investments. Because when you start as an investor, like my first 50 investments, I was just basically donking off $25,000, $50,000 to anybody that sounded like they had a good deck. And frankly, I had absolutely no pretty. Here's $50,000. Good luck, right? And frankly, I got lucky in some of those cases. But what happened over time is that I started to kind of concentrate the things I was doing into some themes, and those became clear when I went through and actually looked at the 200 investments. And so where I was able to create basically 3 times better returns than my venture funds that I was an LP in was when I was investing in those themes, when I was investing in software companies that reduced friction at scale. And the reason is because I was at Microsoft, I ran software companies. There's a high correlation between the people I know, the kind of introductions I can make for companies, and the investment. When I'm investing in CPG companies and I don't have a good network in CPG, I'm just not very helpful. I'm not very smart about CPG. If I invested in drug discovery companies or hardware companies, I'm just not an expert in those areas. My network doesn't align well with those areas, so I'm unable to help them. So that's how the themes sort of evidenced themselves, is that I analyzed all the investments I've ever done. And then after those 200 investments, I said, let me try to make more of those. And for the last 4 years, I've made 72 investments on those 7 meta themes. And that's my new fund. And it's going really well. I have been able to replicate picking good companies in those themes. And it's not just luck, because I'm looking for those specific themes. Things that could be platforms. It's like DocuSign. Basically, DocuSign is the quintessential software platform that reduces friction at scale. If you think about it, you can sign something on your phone instead of using a fax machine. There's millions of signatures a day. It reduces friction in getting something done. There's millions of them a day. Once you start doing it that way, you never want to do it the other way. And they were able to turn it into a platform. One of the big questions, frankly, in DocuSign was, is this a feature or is this a company? Because when a lot of people looked at it in the beginning, they said, hey, signing things on your phone, Adobe could write that in 2 days. And, this is not a company, this is a feature. Well, what DocuSign was able to do was to integrate it into the workflow of real estate companies and other contract systems, and use the signing order and emails and stuff like that. They were able to turn a feature into a platform that integrated into a lot of things, and that's what made it valuable. If they were unable to turn it into a platform, it would have been an order of magnitude less valuable. You see what I mean?
100%. So I want to read these
Okay.
7 meta themes for maybe the people that don't know. Software eats everything. Great founders figure shit out. Disruptive innovation creates new markets. Platforms win. Laziness wins. We're going to go back to that. Invest only when I can be helpful to the company. Invest alongside other very smart, committed people. So I want to go dive into 2 of those. First, laziness wins. So what does that mean? And then number 2, great founders figure shit out. What makes a great founder to you?
Well, let's start about laziness. I remember when Starbucks was going public, I called a friend of mine who's a banker on it, and I said, should I buy Starbucks? And he said, they're selling a legal addictive drug for roughly 50 times more than you can make it at home because Americans are lazy and don't want to make their own fucking coffee. And I'm
Hell
like,
yeah, baby.
You're right. Like you pay 50 times more than you would pay to make coffee at home, and you do it all day, every day because you're lazy. So there is you look at Amazon, lazy commerce. That's why they beat Walmart. So anything, DocuSign, signing on my phone instead of printing things out, like anything which enables ease of use is an amazing business, even if it's a premium business like Starbucks, right? Well, people are charging a premium for something. So anything which enables convenience, that's another way to say laziness, I think is amazing. And I keep looking for those kinds of things. And then in terms of great founders figuring shit out, basically, almost every company, when I'm investing in pre-seed, the companies have figured out an MVP and they're selling something, but most of them have pivoted. The first product you build is almost never the final product that you end up making. I've posted some things on Twitter. I mean, Instagram was something different when it started. Twitter was something different when it started. Almost every company that you can think of that is successful started as something slightly different. Facebook was just for college students, and now it's this generalized social network, right? So every great company has pivoted, and what makes a non-great CEO is somebody that continues their vision and doesn't listen to the market or the customers enough to pivot their original vision, to find to make something that the customers really, really want to buy. When I say figure shit out, like you just keep going and pivoting until you find a business, even if that's not the first one. And I think I saw a video the other day from Gary Tan, who's running Y Combinator, and he said something like 50% of the companies that enter Y Combinator pivot and exit Y Combinator with a different business than they came in with. That's what I'm talking about. Smart people figure stuff out. They're smart enough to figure out that their first idea wasn't as good, and they go on to a second idea.
Strong convictions loosely held. That they think they have a great idea, then they figure out something better. 100% makes total sense.
So that kind of, you mentioned product market fit a couple times, and you have this tweet I want to read that says, your biggest product market fit hurdle is believing you nailed it when you haven't. So can you tell us what your definition of product market fit is?
Good question. And I haven't gotten a really tight definition. I'm actually working on a blog post to try to define product market fit. So I don't have I wish I had a really snappy answer for you, but I don't. But the best way to measure product market fit, I don't know if you've seen the video from the founder of Superhuman about how they measured product market fit.
I don't think I have.
Well, so what they did, so lots of people do net promoter score. I don't think that's a good score. What they do is they ask a question to their customers on a weekly cohort basis. They say, could you live without this product? And what they want, if you have over 40% of your customers saying they could not live without your product, you have product market fit. That's how the superhuman guys define it. So I define it as you've got to have customers pull, depending on your product and pulling your product in. If you're only, and there's different ways to measure that, like how much of your inbound is from referrals, or how much is cold inbound versus advertising. If you are pushing your product with advertising and 95% of your sales are from Facebook ads, you likely do not have product market fit because you do not have enough people searching for your product or being referred to your product by existing customers, right? There are different ways to measure it, but the core idea of actually having product market fit is that the market starts to pull your product, some part of the market. So if you look at Superhuman, what they did is they basically said, they kept doing these surveys and their product was pretty hard to use. But what they decided is that rather than making their product easier to use, they said, we're going to constrain our ICP, our ideal customer profile, to super users of email, to people that value what we have so highly because we save them so much money that they're willing to learn a complicated UI to make their jobs better. So they basically said, fuck you to all the people that didn't like keyboard shortcuts and didn't want a half-hour onboarding. They're like, we require a half-hour onboarding because we have to train you how to use this fucking complicated thing that's a pain in the ass. But once you learn it, your email is going to be so much better and you get so many fucking emails that you value it. So they found product market fit by constraining their ideal customer to a smaller group and then just going after them. Right?
And it's also
so it's not
necessarily flexibility.
It's not necessarily about having a ton of customers. It's more about having a ton of a subset of customers that love your product so much
exactly.
They'll never let it go.
That's what real product market fit is when there are a subset of customers that are pulling your product, that need your product so badly that it's easy to find them, that they refer their friends, that they never leave once they join. That's real product market fit. Not just the fact that you have sales. Anybody can make sales by doing Google ads. That's not real product market fit. A lot of people think they have product market fit when they're growing, 10% month over month by running Google ads. That's not necessarily product market fit. Product market fit is when when you've identified a segment of customers that can't live without your product and start looking for you and pulling your product into the market.
So when do you see startups need to have product market fit in the funding process? Seed fund.
It's somewhere between pre-seed and Series A. Typically, what you're doing in the pre-seed, you've got 4 or 5 customers, you've got a couple $1,000s of revenue, and those are probably customers that you found because they're your buddies or your dad's friends or whatever. And what you're doing in pre-seed is with that money is you're trying to find the next 100 customers, and you're trying to figure out that ideal customer profile. And maybe you get lucky and find that ideal customer in the pre-seed. Maybe you don't, but you do need to find enough customers to get up to $400,000 or $500,000 of ARR. So hopefully you're going to have a lot better idea of your ideal customer after pre-seed. But really in the Series A, that's when they're going to really, really need that number, that ICP dialed in, because for the Series A, you have to have gotten to $2 million of ARR, and they're going to give you $10 to $15 million of money because they want to get that number to 25 or 30 million. And they have to have a really clear shot from 2 to 20. They've got to have a very clear ICP. They got to have a very clear set of channels. They got to have a very clear set of partnerships. You know, the Series A is really funding growth of that ICP, right? You got to get some inklings of it in pre-seed, enough to get $400,000 of revenue. And then in the seed, you've got to dial it in a little bit more. And then you really put the foot on the gas in the A.
Yeah, by Series A, I mean, if you really want to raise a round to sustain you, you need to have that product market fit down by then.
It's got to be dialed.
It's got to be dialed in. So I wanted to pivot a little bit. You talked earlier about how the funding landscape has changed a lot over your career. One of the biggest changes that's happened, which is kind of our space, is equity crowdfunding has been introduced since the Jobs Act, which is a totally new landscape for people. One of your companies that you invested in, it's called Sensate. Mm-hmm. Sensate. It was, They raised on WeFunder. It closed in February of 2023. So what place do you think equity crowdfunding has in the funding landscape?
So I've had 3 companies do equity crowdfunding, and I think there is an opportunity for equity crowdfunding. I also think there's a caution for equity crowdfunding. Which one do you want me to start with?
Start with the caution. I like to go with the bad news.
The caution is that, you can argue whether VCs are good at pricing companies. But in equity crowdfunding, a lot of times the company is the one that sets the terms. And so investors are being asked to invest on terms which are set by the company, not by an individual, an exterior third party. And sometimes I have seen companies pricing their rounds really out of sync with what the venture market would be pricing it at. And usually that's overpriced when it's set by companies. And companies are like, hey, if we can raise money from people, at this high valuation and take less dilution, good for us. The problem is that if you, as a company, ever do want to raise money from professional investors are going to price it based on the venture comparables. And if you raised money at a higher valuation or something, you can get your cap table messed up, right? So I have seen some companies misprice their equity and then put themselves into complicated cap tables if they ever do want to raise from traditional venture capitalists. So I would caution companies to price their equity crowdfunding in relation to what the VC markets are doing, if they ever do want to access the VC market. If you don't care, fine, but it's that disconnect between the two markets that can cause problems for companies.
Gotcha. And the positive?
Well, the positive is that if you are a consumer company, I'm not sure that it's great for B2B software companies that I tend to invest in. But so Sensate is a lazy man's meditation device. The other company that I invested in that used crowdfunding was Element, LMNT. It's an electrolyte stick pack company. I think they raised $5 million on Republic or something like that. but they had at the time 250,000 subscribers, customers, and Sensate had 15 or 20,000 customers when they ran their campaign. And I think it's a really amazing way, especially for consumer companies, to allow their customers to become shareholders. And that's the whole reason why Element did it and why Sensate did it. They frankly, Element didn't need the money. They've been a profitable company since they began. Sensate, did need some of the money, but I think crowdfunding can be an amazing marketing exercise and a way to get your customers to be additional stakeholders in the company. Element in particular, they did a crowdfunding campaign, but they also, they're professional investors like me and other people. They have like Lance Armstrong invested and all these big NFL players. And, all of their investors are influencers. And their bet was that by taking money from those people, the people would put them on Instagram and stuff like that, and help promote them. And they got that after they ran the thing on Republic. Their social media impressions went through the roof because every shareholder that even put in like $100 started putting it on Instagram, right?
Yeah, no, I mean it's pretty in line with what we've seen, over the past half a year or so. It's the direct to consumer brands really thrive
Direct
in
to consumer
crowdfunding.
brands.
They
It's
do
amazing.
fantastically.
Yeah.
It's fantastic. It's basically a marketing and a fundraising in the same. And just as you said, you put it perfectly. Kind of go off that, equity crowdfunding allows, I guess, for the layman to have startups be a part of their personal portfolio. And so I guess my question is, should venture and startups be a part of everybody's portfolio? And if so, how?
No. I do not think they should. There is a reason for the accredited investor rule. It's because these are really highly risk assets. And, I think most retail investors don't understand the power law and the economics related to venture deals. I mean, I have a venture fund. I'm a professional venture capitalist. I see 300 companies a month. I make one investment. I've been doing it for 25 years. I'm really fucking good at this. I still lose 9 out of 10 deals. 9 out of 10 checks that I write, despite being a professional, I lose money on. And I think most retail investors don't understand that even the really good venture capitalists lose more than they win. And so I think it's, I'm not sure that that level of variance is appropriate for every retail investor. That said, if you do want to do it, I recommend, even for high net worth individuals that I talk to, I don't recommend that anybody puts a, more than a low single digit % of their balance sheet into early stage venture. Personally, I have more than that, but that's because I do it full time. But let's say, 5% of your balance sheet. If you wanted to have some exposure, I think you should not have more than 5%. So let's say you're worth $100,000, you can put $5,000 into early stage tech investing, and you can do it through crowdfunding. You could do it through AngelList. You can do it everywhere. But I think one of the problems that a lot of people have is that they get over allocated in this category because it's fun, and they don't realize that it is a really high variance asset class. And if you are going to invest in early stage tech, you also need to understand the portfolio size. If you look at companies like AngelList has produced reports on this. They basically say that you have to invest in 300 companies to have a high probability of having one unicorn. So what that means is that if you're going to, the only way you make money in early stage investing is if you have a crazy outlier. So you have to invest in a lot. So, if you have $5,000 and you need to be in 300 deals, I can't do that math. What is that? $200 or 100, you get $175, right?
Yep.
Something like that to be in enough deals. You can't put $1,000 into 5 deals. You're not in enough companies to have the probability, of the loss ratio and everything like this. That's the other thing that a lot of people don't realize. If you're going to do crowdfunding, first of all, limit it to a small percent of your net worth. Second of all, take that small percent and put it into enough of them so that you have a probability of matching it. Don't do a variable check size either. Don't based on confidence, because you will be no good at picking which one is going to work. Pick a standard check size, put it in at least 50, better 100.
Well, so Martin, the statistic was you have to invest in 300 startups to maybe hit one, have a high likelihood of hitting one unicorn. You've invested in 250, but you have 4 unicorns.
Well, I have 4 unicorns on this thesis. In that 250, I have 12 unicorns. But yeah.
Wow.
I have approximately a 6% unicorn rate, which is 10,000 times better than average, than random.
So does that tie along with your emphasis on follow-on financing? And can you explain more about follow-on financing?
Well, I mean, the only way you get the companies become unicorns is if somebody else gives them follow-on financing at higher valuations, right? And in the last 3 years, I mean, basically up until November of last year, we ended a 12-year bull run in venture capital. We are now in the doldrums of venture capital. But if you didn't have unicorns in the last 4 years, you were doing something really wrong, because there was free money everywhere. But I mean, the only way you get into a unicorn is if somebody after you gives them a bunch of money at $1 billion valuation. Just recently, in the last 4 years, I've invested in 72 companies that have raised a total of $2.8 billion of follow-on financing. 4 of those companies becoming unicorns.
So I was watching one of your interviews, and you said you don't invest in Web3 companies or in crypto companies, but one of the unicorns was OpenSea. So can you talk us through investing in OpenSea, what you saw, and why you thought it was going to be a good investment?
So my bet on OpenSea had nothing to do with crypto. OpenSea is a marketplace. OpenSea is the house in an asset class. So I understand marketplaces, Amazon, eBay, right? They're the house. They get 5% on when somebody does transactions. So the only question there was, I had no opinion of whether NFTs were going to be a thing or not. But I said, this company could be, the house and take a rake on an asset class. So there's only 2 questions. One, does this asset class need a new marketplace, or can you sell these assets on Amazon or eBay? I got convinced that you needed a new marketplace because there were some technical reasons about NFTs and search and all of that stuff. Then the second thing is, how big is this asset class going to be? And my bet was, I didn't know how big it was going to be, but I thought OpenSea could be the leader. And if it got big, then it would be worth a lot. It turns out I got lucky on both of those. It did they are the leader, and the asset class got really big. Now the asset class is smaller, but they're still the leader and still taking a rake. So my bet was, marketplaces, those are software businesses that I understand. I understand how to build those. If you are the leading marketplace, it can be very valuable. So it was a marketplace bet.
So we're running low on time. So I have two questions I want to make sure I get in before we wrap up. The first one is back to your career. You've done a lot of different things on top of being a venture capitalist. Venture capital has kind of gone mainstream. I don't know if it has anything to do with the All In podcast,
Possibly.
but a lot of people are interested in a lot of people are interested in venture capital a lot more than they were seemingly before. So what advice would you give to someone? Maybe there's, I guess, two different types: a young professional that wants to get into venture right away, and what advice would you give to somebody maybe later in their career that wants to get into venture?
For both of them, I would say I think you should become an LP in a venture capital firm. The first thing I did when I started investing is I joined Ron Conway's Silicon Valley Angels. And then you hire a manager like me or somebody else to do the investments. You read their monthly investments. You read their investment memos. You get to understand how a professional thinks about doing venture capital. And then as you're learning from that person or persons, you can start looking at crowdfunding or AngelList or other things to do your own investments. But I would encourage you to join some professional organizations or as a limited partner in a venture fund to learn from the people who do it professionally. I did not, I wasted a lot of money writing checks without context. And I think you can learn a lot by being a limited partner. So I would think either one, wherever you are in your career, I would say join a venture capital firm. And some of them, have low minimums of even like $100,000. Some of them are higher. But I would join a venture capital firm as a limited partner before I wrote a lot of checks myself. And then the second thing I would do is I would make sure I read at least 100 decks before I wrote my first check. Read more decks before you write your check.
Fantastic advice. My last question. You talk about reducing friction at scale a lot. We've talked about that at least 3 times in the interview. What's going to be the next idea in your mind that reduces friction at scale that's really going to change the way we do things?
Well, I think that I'm going to say something which everyone is going to say, but maybe slightly a little bit differently, and it's AI. If you think about it, I don't invest in AI companies. I invest in B2B software companies, and I'm seeing AI as able to solve some business problems an order of magnitude faster than you could have before AI. So AI is going to be able to reduce a lot of friction in a lot of business processes. And you're going to see an explosion of friction reducing things in part because of AI. I'm not sure you're going to call a lot of them AI companies. You're just going to say, hey, I can now solve a business problem that I couldn't solve before because these LLMs are here and they're cheap. I invested in a company that's doing cold outbound email that is now personalized and really, really good and gets a high open rate. I don't call that an AI company. That's a sales enablement company, but it's able to do its job an order of magnitude better because of AI, right? So I really know that AI is going to be that thing like 10 years ago the cloud was. I mean, the cloud allowed people to develop apps an order of magnitude faster and cheaper than when you had to have your own data center. That's AI is the next level of productivity that's just going to cause an explosion of creativity.
Well, Martin, if you taught a class, I would take it. I really enjoyed talking to you today and getting to know you and your investment thesis. And I know I learned a lot. So thank you for taking the time out of the day.
All right.
To
Well,
talk
thank
to us.
you.
Thanks for
And
coming on.
I
We
look
really
forward to
appreciate
hearing
it.
from any of your listeners. Follow me on Twitter. You mentioned it, Martin G. Tobias. And I'm here to try to make this job of founders finding VCs easier. And if you have any great software ideas, hit me up on DM and I'd love to hear them.
Fantastic. And we'll put the link to your blog as well, which you mentioned a couple times. That'll be in the description. So, Connor, I hope you enjoyed it just as much as I did.
This was awesome. We really appreciate it. It's a dream come true. Carver, Brendan, and I were talking about how excited we were to have you on and just to talk to you and, learn more about this the investing frameworks, the investing thesis that you have.
All right. Thank you, guys. Take care.
Yep. And if you, for our listeners out there, we'll see you next time on the Next Big Thing podcast. So long.